Good afternoon. Welcome to this month's Taxing Subjects Zoom Q&A session. This month, we are focusing on estimated tax payments. So if you receive income from sources where there isn't tax withholding, such as self-employment income or rental income. Even sometimes your investments can generate some taxable income that doesn't have withholding associated with it. The IRS does want you to send in estimated taxes throughout the year. So they consider our tax system a pay-as-you-go system. They don't want you waiting until the end of the year to pay in a large chunk of money at that time. So if you don't have regular withholding out of your W-2 pay, you might be required to make estimated tax payments. And there are situations where even if you're having withholding out of your pay, there might not be enough taken out. So you might want to pay in extra quarterly estimates on your own. Quarterly estimates are due, you'd think they would be due every 3 months since they're called quarterlies, but they're actually on kind of a strange schedule. The first quarter estimates are due April 15th. Second quarter is due 2 months later in the middle of June. If the 15th falls on a weekend, then the due date is the next business day. So third quarter is due September 15th, but since that is Sunday, the due date is actually Monday. And then fourth quarter payments are due January 15th of the following tax year. A lot of times people will go ahead and make that payment in December just to keep all their payments in the same tax year. And the due dates for the estimated tax payments aren't as hard and fast as the due dates for your actual tax return. So you pay a little bit before or a little bit after the 15th. It's not a big deal. It's just a general guideline that they want you paying in approximately quarterly. The IRS penalizes you if you don't pay in throughout the year quarterly. So if you owe under $1,000 at the end of the year when it's time to file, there's no penalty. Or if you pay in at least 90% of the tax that you owe in the current year or 100% of what you owed the prior year, you can avoid the underpayment penalty. So a lot of times if people aren't sure what their income is going to look like, I just recommend that they pay in 100% of what they owed the prior year to avoid that penalty. I mean, you still might end up with a big balance due, but at least you would avoid the penalty for that year. So when I calculate estimated tax payments for people, I just base it on the prior year return. And then if we want to do an update throughout the year, if income does change significantly, we can look at it and readjust. But it's really easy to just take what you owed in 2023 and divide it by 4 and say, like, to be safe, pay in this amount each quarter to avoid the penalty. So the penalty is based on interest rates. So with interest rates being higher right now, the underpayment penalty is 8%. So it can add up if you end up with a big chunk due at the end of the year. And I know there are some people who they would rather hold on to their money and they feel like they can make more than 8% by investing in their own whatever throughout the year. So some people choose not to and will pay the 8% penalty because they feel that they can make better use of their money throughout the year. And that's okay. The IRS doesn't mind that as long as you're paying them their penalty. But if you want to avoid that 8% surcharge, it's best to get your estimated tax payments in during the year. So I usually recommend if you're getting income that isn't having any taxes taken out of it, that's considered self-employment income, so it's going to be subject to Social Security and Medicare tax, it's really best to assume that you're probably going to pay upwards of 50% of your net in taxes once you take into account your regular income tax, the Social Security and Medicare tax, and then state of Oregon income tax. It could be lower than that, but if you think like most people are probably in the 22 to 24% tax bracket for federal, and then you add in another 16% for the self-employment tax and 8 to 9% for Oregon. So you have right there, that's 48%. People are wanting to kind of have an idea of what they should be setting aside. I say, 50% to be safe. But that is after your deductions. So if you are having expenses associated with the income, you can take that into account too before you set aside the money for taxes. And then if it's income like investment income or rental income, that's not going to be subject to the Social Security and Medicare tax. So then you would probably just be looking at your regular federal income tax and state income tax rate. So maybe more in the 30% range is what you'd want to be setting aside. Be setting aside that amount into like a savings account or something each month, and then on those months where quarterlies are due, April, June, September, and January, you could send it in as a deposit if you wanted them to hold on to it for you, or you could keep it in your savings account.
What do you recommend?
I mean, I don't like to give the IRS more money than they already take from us. So I think that paying in quarterly is the best option. And personally, like I said, I would rather get a little money back at the end of the year if I overpay than have to come up with more money unexpectedly. So, I have to pay in quarterly for my business because I'm self-employed, and I usually err on the side of overpaying. And then that way, if I do pay in too much, it's nice because when I file my taxes in April, whatever that refund is, I can just apply that to my first quarter payment for the next year and not have to come up with that money in April. And like
Well,
in your situation, since I have all of your tax information from last year in my software, it would be really easy to give you an idea of what you maybe should be paying in or should have set aside. Like if you have a year-to-date summary of what you have made so far, I can plug that in, and then we can just estimate what we think the next few months are going to look like.
Wonder if does it reflect better on credit scores if we're paying quarterly, like with taxes and also with other debt, or does it matter?
They do not report that the quarterlies to the credit reporting agency. So that wouldn't affect your credit score at all. Really, paying in on time quarterly isn't like paying your car payment on time where you get a history of good
Right, right.
payments. So yeah, that wouldn't necessarily help your credit score, but it also shouldn't be hurting your score either by not paying quarterly and just paying in at the end of the year. Like having a large balance due and getting hit with an underpayment penalty doesn't affect your credit score either. It's not like that would lower it even more. Well, thank you for joining today to talk about estimated tax payments. Like I mentioned, if you're self-employed or you have income that's coming from sources that don't have tax withholding, it is a good idea to pay in quarterly. And the best way to do that is to go online. You can go online to irs.gov/payments, and you can actually schedule out a year's worth of payments for the date and amount that you want them to come out. And then if things change and you need to cancel them or revise the amounts, you are able to do that before the payment due date. But that can be very convenient, so you don't have to remember to go in 4 times a year and make those payments manually. So I'll go ahead and post a link in the comments that has some information about where you would go to make your payments online. And if you need help calculating what you should be paying in, I'm always happy to do that. I can do a W-4 analysis. If you're paid on a W-2 and have taxes withheld, I can look at that and see if they're taking out enough. And then if you have income from other sources, if you can give me an estimate of what you think that income is going to be for the year, then it's pretty easy for me to come up with some totals and give you some amounts to pay for estimates. But they are called estimates for a reason, because it's not a science. It really is just using the data that we have available to estimate how much you're going to owe and then divide it into quarterly payments. You also, if you have a big chunk of money come in at the end of the year, obviously you wouldn't have known to be paying in quarterly. So for example, if you have a huge capital gain in December, then you might want to make a January fourth quarter estimate, so that you don't have a large balance due when you file. And I also just want to mention, this is kind of a little bit off topic, but a lot of times people think that filing an extension for their taxes is giving them extra time to pay what they owe. And an extension is actually only an extension on time to file. So taxes are due by April 15th. Your payments are due by April 15th, and any amount that you pay after that is subject to a late payment penalty and interest assessed by the IRS and possibly your state as well. So if you are going to need to go on extension because you don't have all your documents yet or you're not prepared to file, I recommend making an extension payment and estimating to your best ability what you think you're going to owe at the time, just to avoid those extra penalties and interest. I know a lot of times you file an extension because you don't have the money to pay. So if that's the case, then there's not a lot that you can do. But just be aware that the extension is only giving you extra time to file, not extra time to pay. So thank you for joining me today for this month's Taxing Subjects Q&A about estimated tax payments. If you are self-employed, I do have a new ebook out, Taxes for Self-Employed Individuals. I'll try to post a link to that here in the comments. It's just a quick 15-minute read that will give you some oversight about what it means to be self-employed and what your responsibilities are as a self-employed individual as far as what you can deduct and what taxes you're going to owe. So that could be a helpful tool for you if you are self-employed or a gig worker or looking to become self-employed. Well, happy Friday, everybody. Thanks again for joining us, and I look forward to seeing you next month. Next month's Taxing Subjects Zoom session is going to be geared towards realtors. We're going to be talking about tax deductions that realtors can take, some different tax strategies for how to structure your business, and some benefits that you might have as a realtor if you wanted to invest in real estate yourself. So if that's you, or if you know a realtor that might benefit from that, feel free to invite them to next month's Zoom. It will be on October 11th, which is a Friday also, and at noon again. So thanks again for joining us, and we'll see you later.